Hello and welcome to the Money Show, the place where money stops being confusing and starts working for you. Because let's face it, every decision we make, from the coffee we buy in the morning to the home we dream of owning, from planning our next holiday to securing our children's future, has one thing in common, which is money. Let Despite the role it plays in every chapter of our lives, very few of us were ever taught how to manage it, grow it, or make smarter financial decisions. That's where we come in picture, whether you are just starting your financial journey, building wealth, investing for the future, planning your retirement, or simply trying to make your salary stretch a little further. This is your show. We also answer your portfolio queries. QR code is on your screen. You can WhatsApp your query on WhatsApp number also 865-797-4571. So we'll answer your all queries related to personal finance, related to mutual fund. Get your portfolio reviewed by our top experts. So moving on, as investors navigate changing market conditions, the focus is increasingly shifting from short-term market movements to how portfolios should be positioned for the longer term, with valuation, interest rate, global risk, and domestic growth all influencing investment decisions. There are several questions investors need to consider before deploying fresh capital. Today we look at where investor can find opportunities over the next 12 to 18 months and how they should approach the current valuation environment. Should investor wait for a correction, stagger their investment, or remain invested through market cycle, and understand how investment strategies could differ based on risk appetite, along with key do's and don'ts of building and rebalancing a portfolio. To discuss all this and more, I'm joined by a very special guest today, Asit Bhandarkar, Senior Manager at JM Financial AMC. Thank you so much, Asit, for joining the Money Show.
Thank you very much for inviting me, and good evening to you and your viewers.
Sir, just to begin with, sir, you can mute if your TV is also on, because I can, if you can mute your TV, because my voice is echoing back again.
No, the TV is not on actually.
Okay. Sir, do you think that in last two, because we have seen that in last 2 years, markets have not given returns and there is some sort of disappointment among retail investors, those who entered in market in 2024 or in start of 25. So what would be your advice to all those retail investors?
Well, see, I think we have to just step back and see what has happened since 24, right? I mean, if you invested in 24, you had participated after a roaring bull market in equities of 3 years. You had invested perhaps when the market valuation was at an all-time high. If not all-time high, at least India had the highest valuations among global equity markets. I remember very clearly that the valuation of our index, which is the Nifty 50, was about 24p on a forward basis, which was fairly high. And at the same time, global markets were significantly lower. And post that, we did see an earnings deceleration. We saw the economy slowing down. We saw earnings deceleration, which clearly challenged those very high valuations. What also has happened at the same time is that global markets, especially the developed markets, have had sort of a earnings surprise driven by AI, etc. And we've also seen some of that percolate into Asian markets like Korea and China, which also compete for emerging market money, right? So yes, you're right. I mean, somebody who invested in 24 would have not had a great experience. But I think we have to just distinguish that, because now in 26, what we are clearly seeing is a lot of steps that government took last year. If you remember, we had a GST cut as well to spur demand. Impact of all that is starting to sort of come through in the demand that companies are seeing. Earnings growth has been stupendous for this quarter, and this is in spite of the fact that we had quite a big challenge in terms of the very high crude prices and commodity prices, etc., going up because of rupee depreciation. In this kind of an environment, we've had a very solid earnings season which has just passed by. Markets clearly have sort of given a very positive feedback to all this, and I think post the markets bottoming out around middle of, or rather at the end of March, we have seen markets also come back, the broader markets particularly, come back quite favorably. So I would think that when earnings are strong, then market is in a fine fettle.
What's a fund manager's playbook for next 12 to 18 months?
Well, from our perspective, see, we do recognize that the earnings are quite fine right now. Economic recovery is quite strong. We are seeing credit growth being very strong, which is sort of telling us that overall the mood in the economy and the demand outlook seems to be quite robust. And we are trying to assess by our research, etc., as to where the demand surprises can come and where the valuations are commensurate or attractive enough for us to play. So we continue to back sectors where sort of valuations are very, very reasonable, and given the improving growth environment.
Help us with the three sectors where you think that valuations are reasonable and upside is there.
Well, from our perspective, see, in India, financials continues to be the largest sector. And there, I think quite clearly, as I mentioned, the credit growth being so strong and the asset quality having bottomed out, valuations being reasonable, gives us enough opportunity. And that opportunity not only is there in the lending businesses, but it's also there in the financial services businesses, where there could be some interesting opportunities. Other than that, what we see is that one of the big problems that Indian economy could have faced is because the crude prices went up and rupee has depreciated. But what we are broadly seeing is, as an economy, our ability to bear the hit from higher crude prices is today much, much better than probably what it was in the previous decade. And on the contrary, there are businesses which are now sort of starting to benefit because of the weaker rupee and the stronger export opportunity. We also are looking at this in the context of the FTAs.
Okay. So, what would be your suggestion to our viewers who are watching you today? Where should they put their money for a time horizon of 2 to 3 years? And any advices, do's and don'ts to our retail investors?
See, I think from my advice typically, and please take it with a pinch of salt, because I'm a fund manager managing equity funds. But that said, the advice, and I think the biggest learning from your earlier question, that somebody who invested in 2024 has not had a great experience, right? So my point is, stop chasing returns, have a very balanced asset allocation. uh, Certain segments of the economy will do very well at certain points of time, certain will not. But that should not change your asset allocation. So my advice to retail investors is, first of all, don't lose hope in equities because of very weak performance over last, say, 2 years. Second, be very balanced in your approach. Look at your long-term asset allocation and keep your investment horizons long enough to undergo any volatility that may come. See, geopolitics is the way it is globally. We're going through very interesting times. Currencies have had their own movements. We are seeing interest rates in developed markets going to fairly higher levels that we have not seen in the previous decade. So interesting things are happening. But that said, a disciplined approach, even in this environment, is far more useful approach rather than being fearful or being negative about things.
Okay, sir. So, sir, my final question to you, sir. According to you, one mistakes retail investor should avoid in current scenario, current geopolitical turmoil, where in last 2 years retail investor has not seen returns, and you have mentioned that don't lose hope and your time horizon should be long term.
Yeah, see, my advice is very simple, and I think that is I think the whole point that we tend to look at our near-term experiences and extrapolate them into our decision making, right? So if near-term returns are very high, then we'll put more money, and I think that's a wrong approach. I think that is the whole point. I think we should not chase returns. We should, on the contrary, be constructive when the market falls or has not given sufficient return, especially when it's in the back of improving economic data and improving earning scenarios. So my point is very simple. Don't get carried away on either side. Don't let near-term affect near-term economic data or near-term news or near-term stock market outperformance affect your long-term planning. That's I think the basic mistake that most people will end up doing. The mistakes are that you don't participate because of being negative when you should, and mistakes are that you end up chasing returns when they are very positive.
Well said, sir. Don't chase the return and consistent with your investment strategy and should not get carried away with the near-term data. Thank you so much, Asit sir, for joining The Money Show and sharing your valuable insights about the retail investing and what do's and don'ts should retail investors should keep in mind. Thank you so much.
My pleasure. Thank you. Have a great evening.
So now time for a short break. Don't go anywhere. We'll be right back after this short break and we'll take your mutual fund related queries from our experts. Welcome back after the break. Now I'm joined by Nisreen Mamaji from Moneywork Financial Services to answer all your mutual fund related queries, to answer all your personal finance related queries, to answer all your investment related queries. Thank you so much, Nisreen ma'am, for joining The Money Show.
Thank you so much for having me. Pleasure's all mine.
Ma'am, shall we start? We have a lot of queries for you to answer.
So let's go ahead.
Okay, so first query is from Kedrick. Kedrick is from Mangalore and of age 57 years. He has returned to us that looking for an SWP for senior citizens, need 1 lakh per month for 20 years, wants to know required initial corpus. Should he use 1 fund or 2 fund or 3 fund? So, ma'am, Kedrick from Mangalore, what would be your advice for Kedrick?
Hello, Cedric. How are you? So basically, your requirement is a systematic withdrawal plan. You're 57, close to retirement. So this is for typically, your retirement withdrawal that you are using. So now, in order to withdraw about 1 lakh a month, which is approximately, equal to 12 lakhs a year, this you need for about 20 years. So the estimated initial corpus when you start your withdrawal will be close to 1.2 to 1.35 crores, assuming a conservative 8 to 9% annualized return from a hybrid portfolio, so that your principal can remain intact. Okay. If the 1 lakh was to per month, if you wanted to increase with inflation by say about 5%, then the initial corpus you need will be closer to about 1.5 to 2 crores. Because every year you want to also keep pace with inflation, and 20 years later, it will not be the same thing as withdrawing 1 lakh a month right now. So those are the choices and the range that I can easily provide to you. If you want to just use up the corpus and exhaust the corpus, then you can even start with say 1 crore to 1.10 crores in the beginning. But then at the end of the 20-year period, your corpus will not be intact. So I've given you three scenarios, and either of them you can use. Now the suitable categories for mutual funds could be pure equity funds in your case could be a little volatile because of the market conditions. So a conservative to moderate hybrid strategy will work very well for you, and you can select say 60%, like in a very stable kind of funds like hybrid funds and equity savings funds, and the balance 40% in more dynamically managed funds. So you could select, 2 to 3 funds. You could select HDFC Balanced Advantage Fund, ABSL Multi-Asset Fund, and ICICI Prudential Regular Savings Fund. So these are the three choices that one can provide you. And you could do like a 60-40 ratio, 60% say in HDFC Balanced Advantage and IPRU Regular Savings, and say 40% in a multi-asset fund like Aditya Birla's. Hope that has helped you, Cedric.
So moving on, ma'am, we have 8 to 9 minutes more, and I got a 4 more queries. So next, our caller is Manish. Manish, ask your question.
Yeah, thank you for taking my question. So I am 46 years of age and I have another 12 to 14 years of retirement. Currently, I'm doing an SIP of 21,000 rupees per month, which I had started 1 year ago. And this is split across HDFC Balanced Advantage Fund, ICICI Value Fund, Parag Parikh Flexi Cap Fund. Each of these funds are 5,000 rupees each, and 4,000 rupees in ICICI Nifty 50 Index Fund, and 2,000 in Nippon India Small Cap Fund. So just want to check if this fund is, if these funds are good. And also I want to increase my SIP by another 10 to 15,000 rupees. And I have also 1 lakh rupees surplus to invest. So what will be your advice, ma'am?
So in order to, to reach your goal target of 1 crore rupees, if you continue with the same, funds at about 12% compounded annualized growth rate, in 14 years, your corpus will be around 91.5 lakhs. So you can also start with a 5% step up every year, or you said you already want to increase 10 to 15,000 per month. So you will comfortably reach about 1 crore if your compounded annualized growth rate for the next 14 years, you're able to achieve about 12%. As far as your funds go, I think you have an excellent choice of funds. The fund selection and category balance between large cap, flexi cap, hybrid and small cap are well constructed. So you can continue this allocation, and you can do the annual top up, as I've mentioned, across the board. Since you have another 100,000 to invest, you could invest it in ICICI Pro Value Discovery and Parag Parikh Flexi Cap, just divided equally between the two. There is a minor overlap between, the Value Discovery and Parag Parikh Flexi Cap. Both are, lean and value oriented. But so there's some style overlap. It's not harmful. It's, not adding too much diversification in your portfolio. You can continue all the funds as you have invested.
Okay, so it's a response to Manish. Manish, any other question you want to ask?
No, that's it. Thank you very much.
Okay, so next query is from Shiva Kumar. Shiva Kumar from Madurai. He is of age 57 years, invested 3 lakhs in Tata Digital India Fund. SIP has been stopped. Want to know whether to exit or wait. Yes, ma'am. What's your advice for Shiva Kumar?
Yeah, so this is a sectoral IT fund strategy. So the decision is not on whether the fund is currently in profit or loss. Actually, Tata Digital Fund is a sectoral IT fund with at least 80% portfolio mandated towards IT sector companies. So as of July 26, it's considered very high risk, and it's got about 61.5% in IT, with major holdings being Infosys, TCS, and Tech Mahindra. So the important point is that the fund has actually delivered 16.29% annualized return since inception. The return recently has been a little weak. It's minus 7.52% over the last 1 year and 6.83% annualized over the last 5 years. So basically, since Mr. Shivkumar is 57, closer to retirement, the important question is, what is this role, this role of this particular fund in this overall portfolio? Because 3 lakhs is a small satellite allocation, and if you have a 7 to 10 year view still going forwards, then you don't have to exit. But if this is a large part of your portfolio, then I would consider reducing this exposure and moving this money towards a diversified flexi cap, large cap, or mid cap, in the broad market index. Also, don't continue the SIP in a digital IT fund just to average down unless you want further sector exposure in IT. Yeah.
Okay.
All right.
Okay, ma'am. My last query is from Venkat, age 75, invested 4 lakh in Kotak Multicap Fund. Want to invest another 6 lakh. Total investment would be 10 lakh. Investment horizon 2 to 3 years. Want to know expected growth. Ma'am, you have only 40 seconds to answer this question because we are completely out of time now.
Right. So 10 lakhs, invested, 4 lakhs existing and 6 lakhs new. Over the next 3 years at 12% compounded annualized growth rate is about 14 lakh. Critical advisory for senior citizens is that multi-cap funds are equity heavy. Kotak multi-cap mandates a minimum 25% allocation in large, mid, and small. So therefore, the expected growth for a 2 to 3 year horizon, equity carries a large downside risk. So rather than adding the full 6 lakhs into the same category of funds, it would be better to go for a hybrid or a balanced advantage category because your time frame is only 2 to 3 years going forwards, and keep the existing 4 lakhs in the same category. All the best.
Okay, thank you so much, ma'am, for joining the Money Show and taking all our queries. We are completely out of time. So on this note, it's a wrap on this edition of the Money Show. But stay tuned to ET Now. And if you also have any questions or queries, here our barcode and mobile number, which is 865-797-4571. You can send your portfolio, you can send your investment related query, and our expert will take your queries. So that's a wrap on this edition of the Money Show. On the other side, more on the other side, stay tuned to ET Now.